Hello there, this is Dr. C.K. Narayan coming to you from Neo Trader, and we are currently facing pretty tumultuous times in the market, right? And that is creating a lot of difficulty. So, a few of our clients and viewers asked me to share some opinions about the market as to how one could deal with it. So, I thought I would, take this opportunity to reach out and share some thoughts with you. I'm not claiming to have any solution for the current set of problems, but yes, I do have some set of thoughts which I think I could share with you to a certain extent. Okay, so first things first. First thing is that we have to realize and admit to ourselves that matters are not the same since October of 2021. And why is that? That is mainly because we have been used to a very, very strong bull market, which has lasted for about, something like 19 months, March of 2020, all the way till October of 2021. So the overhang of bullish sentiment is very, very large, and that creates problem for us all when we have to change over to what it is. Second, the market, as maybe here, if I just were to add the chart, right? So you can see the chart. This is the Nifty chart. What we are seeing on the Nifty chart is ever since the market made this stop in October, there have been these huge swings. So this is 18,500. This thing came to somewhere around 16,000. So on an average, these swings are all very, very large. They are about 2,000 points on an average. Now, here is the problem. What happens is, by the time you realize that, the market has changed a bit, right? So, somewhere you're moving down, and when you're moving down, this is what it looks like as, this is still a part of the decline. Right? Part of the advance, and then this one looks like it's going to continue up. But just as you think that this is going to continue and you probably went long here, you got slammed with this decline. Now, by the time this whole decline happened, now your entire mindset has changed, and you are now looking at the market with a great deal of more fear about what is happening. Just as you were starting to get afraid, then the market comes and does this. A very, very robust and strong advance, right? And you probably got comfortable on this somewhere above this line and said, oh, this is the bad times are over, and then this was the low, and now it's off to the races again. So just as you were getting comfortable out here, the market turns right down and slams down to a much lower low compared to what it was. Now by here, this was somewhere in March. Right, in March, when the index hit about 15,700 levels, many people had turned bearish, and they were ready to call for much lower, levels of the interest. And the market suddenly put in a nice small hammer type, followed that up with a bullish candle, and then away we went in a rocketing rise, which went up to first week of April, right? So once again, everybody said, oh, it's all over. But then by the time we got into stride with it was somewhere in this particular gap. So you got bullish somewhere out here, and the market obliged you by going up a little more. And just as you were getting comfortable at about, 17,700, 800 area, the market has come back and slammed you right down and brought you all the way back till 15,700. So what has really happened here is a series of big moves, and those big moves have, because you turned sort of bearish out here and you turn bullish a little late, once again you turn bearish a little late, and series of that happens. People have been losing more money than they have made during those brief times when the market obliged them. So now that is creating a problem, that this entire area has now become one huge confusion zone. And very few of us really have an idea whether the market is really headed up or it's going to go down further. Now, as the market goes down, everybody likes to call for lower levels. As the market goes higher, everybody likes to call for a higher level. This is very, very typical of human behavior, and this market is no different as of now. But we have to see something, and for that I will want to switch to let's say the monthly chart. And when I switch to the monthly chart, and we find that there's been about 19 months of advance, like I said, and about 7 months of decline. Now, 7 months of decline is reasonably small when you compare it with a 19-month advance. Okay. Then you see another item, which is that this fall, even though it looks large, when we saw it in the daily chart, it looked large, right? It looked like big 2000 point swings which are going to, knock us out of the game, either when we are short at lower levels and takes us out at higher, or when we are long at higher levels and takes us out at lower levels. But now when you raise perspective, what do you find? What you find here is that the price damage which you have here is extremely minimal for something which has been such a huge rise, right? So the price element is also minimal, the time element is also minimal. So typically in a correction, both price element and the time element have to be completed. Now typically using technical analysis, what do? We put up a Fibonacci retracement to check the prices. And when you check the prices, you find that, okay, the 23.6 is not defined. Let me add that also. You're finding that the prices have fallen only to the 23.6% retracement of the whole advance from March 2020 till October of 2021. Now this can be seen in two ways. The first one is of course the bullish way, which is what everybody would like to hear, but I don't know if that is going to be the case, but still, let's first examine the bullish case. Now, if a market across a 7-month period is very, very reluctant to give up its rise, then that means that the bulls are still very much in control. Now, if the bulls are in control, then the chances are that bulls will make a stand somewhere here and try to take the market up. So that is one side of the equation where a minimal retracement indicates a strength with the bulls. The flip side of the coin is that if we assume that the market has indeed made a high around here, October of 2021, and this is only the first leg of the corrective. Now you may say, how is it first leg of corrective? Because there have been so many legs of correctives here. If you see here, there's been a big corrective, and if you use something like corrective pattern, this seems like a multi-leg correction which is completing some sort of a pattern at about 23.6% correction. Now, if we take it that this correction is not sufficient, now 7 months is not sufficient in time, 23.6% is definitely not sufficient in price extent either. So if you're going on to the bearish bandwagon, then the evidence is in support of you as well, saying that the price and time element both are not sufficient, and therefore after maybe giving you an oversold rally from here, right? This is into an oversold area, former levels where the market used to find a lot of support, 15,700 area. This was 15,700 area. This again is 15,700 area. So a well-defined support area. Completion of some sort of a WXY or XZ, if you were to look at a double correction using Elliott, etc., or you want to take it at a larger perspective and just make it into an ABC kind of pattern, whatever. There is evidence of some sort of a pattern reaching its out direction near former support zones and near retracement zones. So, and oscillators were in oversold, so possibly you may get an oversold bounce. Now, if you get an oversold bounce, and assuming that these were all on an average about 2,200 points, okay, so you should be also getting something along that range, say about 1,500 points should be your extent of the rise. Now, since this whole area is overlapped, and whenever you have an overlapped area, it becomes a corrective setup. Now, unless this new rise which we are expecting, unless that shows characteristic of a new bullish phase, we cannot label it as being a new bullish phase, and therefore if it is not going to be a new bullish phase, then it has to be part of the old corrective phase. Now, if you are in the correction camp, then more evidence is available for you to hold on to that view than there is available for bulls to hold on to their bullish view. For the bullish view, we had only one particular item, that the price damage in this correction has been very, very limited. Now, with this can mean that people have not really sold, in the sense the FIs have been sellers, of course, but the DIs have been consistent buyers, and retail money has not really gone out of the market. In fact, as late as April's figures for mutual funds are concerned, there has been inflow of money into the market, although at a slightly reduced pace compared to earlier months, but still the money is coming in from retail. So we have seen that across the last 1 year, a mix of domestic funds and retail funds have ensured that the market stays afloat. Can that happen in the future? I have no idea. I am a bull at heart like anybody else in this country, and therefore I would wish that to be the case, and that this 23.6% retracement will hold and people will find enough necessary reason to come up and put their money to work in the market afresh. So, given this is a situation, and given the fact that the weight of the evidence currently is leaning towards continuing correction and not towards continuing uptrends, there are certain things that we should do. First is, of course, we have to accept this as a fact that the market may have turned and got into a bigger corrective phase. So now the question is, how do we handle this situation? See, if a bull market emerges from here, then there is no problem. Everybody is happy and life is back to normal, and we all can go back to what we were doing a year ago or 6 months ago. But the problem is, what if there is a change setup and this kind of big swinging corrective market were to continue or persist? Then there are certain things we'll have to do, and that is what we got to be prepared for, because we are steeped in the old ways and nobody needs to educate us as to how to behave in the old pattern. What we need is perhaps a realization and an understanding of how to act in a new paradigm. And for that, the first things first. Everybody has been investing aggressively and making a lot of money with it, except those who came in late September, October, or post that, they have been taking a hit. So if you're going to be in a corrective, number one thing is to roll back on investments, because in a corrective market, it's difficult to make money through investments. And unless you are extreme expert at stock picking and you pick just those right stocks which go up also in a corrective phase, right? And second thing, so that was about investments. You have to be very, very selective about investment. That is what I'm saying. I'm not saying that don't invest. I said roll it back a bit. So if you are putting 100 rupees into the market as investments every month or every time you invest, make it perhaps down to 50 rupees or even maybe 30-40 rupees, right? So that is the first thing. Second is that when you get into a corrective mode, it becomes difficult for breakouts to sustain for too long, right? So traders in particular are used to trading breakouts, even in the lower time frame charts, and particularly short-term investors are very used to using breakouts from formations of any kind on the charts to invest or buy into stocks. So I think there has to be some additional element which will qualify the breakout, right? I'm not saying breakouts will all fail, but all breakouts will need additional qualification. So you need to be looking for it. So the third, so this is the second thing that you need to look for. The third element, I would say that if you are taking trades, and now this is looking like a large sideways particular kind of thing, if we are going to get price damage later, I think that will happen with some news flow or some event. So that itself will prompt us at a later point of time if we have to change strategies again. But given that the current situation, if it were to persist for some more time, what we need to do is in our trading and even in our short-term investment, we need to take smaller profits. Okay, we shouldn't be expecting this multi-bagger nonsense to take place in this market like this. So just get rid of the thought about multi-baggers, and if you are making some 5%, 10%, that ought to be good enough. After that, you make your stop losses tight, and if you get more than that, be happy with whatever the market is willing to give you, but also set some standards by yourself at which level you will take the trade-off. So those big super runs that we saw in 2020 and 2021, I think they're all going to take a rest for a while. Now traders need to shift a little from following trends. So trend following strategies are not going to work very effectively in these kind of markets. So you may have to bring in some amount of range trading. So fortunately, 2000 point swings on the index will give you sufficient range size even among the stocks. So you need to pick the stocks correctly which are showing you wide swings in line with the index. So the number of stocks that you will trade in will have to come down, and those which are kind of mimicking what the index is doing, that is something that you must shift towards. Now, for traders who are extremely active and who do a lot of BTST work, I think choppy markets like this are dominated by opening gaps. And when you have opening gaps like we have been having on the index, almost every couple of days we have this large opening gap, and that really screws everybody's saying happiness. And therefore, I would say avoid BTST if you can, or if you're going to take them with high conviction if you have them. And if there is a big gap against you, then have a protective way that you will get out of those BTST trades if you do that. Then moving ahead, I think those who are of an analytical bent of mind, or do some sort of analytical work using technicals, I think this will be a time where you'll have to do a little more work. And a ranging market where swings are there in across the stocks as well as in let's say in stocks. I think ranging markets will actually need you to identify overbought and oversold levels before, not in the live market. So you'll have to do offline market work in the sense that they will have to be identified in advance on the chart. So technically oriented people should most definitely need to work harder. They need to have a smaller list of stocks, active ones, which are showing a certain amount of volatility, but not excess, but certainly some amount of volatility which you can take advantage of with range trades, identifying oversold areas. So some amount of technical knowledge here would be greatly advantageous. If you don't have it, take recourse to some people who can provide you such service, etc. And finally, I would say that this market is one which requires patience. Now you need patience for two things. First is patience to last out this pretty volatile phase that we are having, so that you can find out whether we are still in a corrective phase, or that enticingly possible continuation of bull market can still happen. But that requires patience, and that requires surviving this particular phase of the market. So don't blow yourself out of the water. That's what I'm trying to say. Be selective and be patient, waiting for a bigger signal to come. Currently there is no bigger signal. Currently it is all a big mess of a sideways market. Now, along with this, you will also need to, shore up your existing capital, because in markets like this, when you trade or even when you invest for the short term, you will have to book out a series of trades with a stop loss. So your capital will keep getting eroded little by little by little, if you are ensuring that your losses are going to remain pretty small. So ensure your losses are small, maintain patience, and you'll have to beef up your capital. Now, there is bad news for people who are come to the market trading with 50,000 capital or some 30,000 capital. Well, the bad news for them is, if they have not got wiped out already, I think the market will continue to remain very, very inimical to them, and you are in grave danger of losing out if you have a very small capital. I have spoken about this subject of capital very many times, and in fact, I've done a couple of episodes which you might get to see if you look at our array of videos which we have done, where I've spoken specifically about allocation of capital. Do check out for those videos, and if you cannot find them, take assistance from our office. But this capital thing is a must in a market like this, because success rate will be very low in this market. Okay, so when success rate is low, there are two things that you must understand and accept. that you'll have a lot of trades which will go wrong. But you have to ensure that you don't lose too much money in those trades that go wrong, because then your capital can get eroded badly. If it has got eroded some extent, you'll have to get it replenished. And supposing the bull market is still alive and kicking and it's going to make a comeback, then this would be a good time to put your capital to work, the additional capital, because the market has given you a 15% cut from the highs. And many of the stocks, but even among the blue chips, there have been many blue chip stocks which are down 30, 40, 45%. And on an average, the mid-cap, small-cap stocks are down about 35 to 40%. So, nicely wound down market, but nicely wound down is valid only if the bull market scenario is going to resume. If it is not, this winding down is not of much use, because you're not going to have very big jumps. So I'm speaking both sides of the coin here, because we are poised at a level where the market has found previous supports and it is trying to rally from here. And the question really is whether this is going to be a rally, or will the market uptrend resume soon in the near future. Current weight of evidence, summing up therefore, current weight of evidence is still favoring continuation of the corrective phase, because we have only one or two pieces of evidence for continuation of the bull market. If you look at it from the triggers that we have the end of low interest rate regime. It's it seems across the world, the Fed has raised rates, the Reserve Bank has raised rates. So if money is going to become dearer, if liquidity is going to dry up, if growth is getting a little stifled, we are seeing the market not really rewarding even stocks which are showing some amount of good growth, etc. That means all those things are already priced in. And then you have technology stocks taking hit, and multiple sectors taking hit, particularly also in the US, and the FIs continuing to sell. So inflation is raging, even though we are up. April was 7.79%. That's a scary percentage, because Reserve Bank had set a ceiling at about 6%. But in the US, inflation is at a 40-year high. But that's because they had ridiculously low inflation earlier. So it's a kind of a base effect. But across all the developed markets, they are all having 20-year highs, 30-year highs, 40-year highs, and that is going to impact their psyche. And therefore, the amount of money moving into India or across the emerging market set is definitely going to get impacted. So if liquidity is going to be a factor, if inflation is going to be a factor, if dull growth in corporate earnings is going to be a factor, if trends are going to be a factor, I think all these are votes for continuation of the corrective phase. So not very good news at the moment, but then everything is subject to change. Market is, as the cliche goes, trends are something which can turn on a dime. You don't know which event or which news will trigger that. But until that does happen, what I said to you earlier, have patience. That holds good. And so patience, capital, reduced trades, rolling back investments, looking for ranging trades, and following breakouts less, taking some efforts to finding out support zones and seeing movements of them. All these are the things that you need to do to handle the current market situation. I hope these thoughts of mine add some value to what you're doing. If you do like what you heard, please share our videos with your friends. Please like our videos on our YouTube channel, subscribe to our channel, and hit that bell icon so that you will know when new videos are uploaded. For those who have subscribed already, our deep thanks to all of them, and I hope you will continue to remain tuned to the Neo Trader channel. Thank you so much, and until I see you again, this is Dr. Narayan bidding you goodbye.